Hello, my YouTube friends, and happy Sunday. We got Jacob back with us again. It's been about a week. I know last week he wasn't in the video, he wasn't feeling so great, but this week feeling a little bit better. And we're going to go over the account that we opened for him with the 3 stocks that we owned. Actually, some things that changed this week where we got assigned a couple things and we also sold one thing. So we're going to discuss that, and he's going to decide what options he wants to sell for next week or potentially even next month, which I might throw a curveball in there and explain to him as we move along. So, have you had a chance to kind of review a bit?
A little.
Okay. So, which one do you want to start with?
Soundhound.
Okay, so Soundhound closed on Friday at $19.02 after going crazy. I think I mentioned to him one point during the week, it got as high as I think $22. But by the end of the week, it closed at $19, which for somebody looking once a week, that's great because he would have been really stressed about, he had sold an 18.5 call. And since it was way through that, I know when we talked about it, he was like, oh, that's a bummer. But let's see if he even understands what I'm saying with this. So originally, he had 200 shares. He sold a 17.5 call that got taken on the way up. He then sold a 17.5 put, which got exercised on the way back down. And then as it went back up, he sold an 18.5 call, which from my perspective is amazing because on all of those trades, he collected premium. And do you understand what happened there?
Not really.
Okay, so originally when he sells the 17.5 put call and gets taken on those shares, he sells the stock. He then reverses and sells a 17.5 put, collects more premium. As the stock falls, he then buys those shares back. That ends up doing nothing in terms of making money on the stock because you've bought it and sold it at 17.5. But then it goes a full dollar higher and you sell it at 18.5. So you make $100 extra on the 18.5 call. Does that make sense for you? And you collected more premium. We sold that 18.5 call for 80 cents. So he made $180 in 1 week on those shares of Soundhound. Now do you understand?
Yeah, no.
And now he has an opportunity to sell a put again and collect more premium. Now, what I've kind of given him advice on in terms of what to do with a stock going up, and this week we'll talk about one going down, is maybe just if you have only 100 shares left, let it be, unless that's where I'm going to throw a curveball in when we talk about it and give some different options. Because if you just get lucky and you picked a good stock that keeps going, I don't know that you just want to be sold completely out of the position and end the trading. So when you looked at the options chart, what were you looking at that you wanted to do on Soundhound this week?
Well, I was thinking maybe a call again.
Okay, and what one were you looking at?
Well, it's at 1919, so the most reasonable one would probably be 20 or 2050.
Okay.
Except the only thing is I can't see the 2050 price.
Okay.
That's the only thing.
So I'll throw a curveball in a little early. If I were thinking of selling another call on Soundhound, I might look further out at a way higher price. And I looked out a full month, which wouldn't expire until November 21st, which I didn't send him. So that's what I'm just explaining. The $30 call gets 71 cents. So you would collect $71. Now it's a full month away. But if it got above 30, you'd make another $1,000 on Soundhound.
And if not, I'd still gain.
You'd still own the shares.
Yeah, I might do that.
Okay. Now, out of curiosity, I looked at the puts a month out also. And again, I know I didn't sell you that screenshot, but this just gives you an idea of what adding time does to the options. And then you don't even trade it as often. So what put were you looking at for Soundhound?
For this week?
Yeah.
Probably like I did last time, 18 or 1850. Wait,
Okay.
Did I do that last time? Or
You
was
did
it
the
like
17.5, but that's okay. You sold the 18.5 call.
Oh, so maybe just an 1750 put again.
Okay, and what does that pay?
43 cents, which is still a good deal.
Okay. So now, if you went all the way out until November 21st, the three puts that I looked at was a 15 put, which pays 81 cents. Yep. A 16 put, which pays $1.28. And a 19 put, which I know sounds really aggressive because
It's
you'd,
at 19.
and you had sold it at 18 and a half. But what do you think a 19 put might give you?
Like $2.
2.66.
Damn.
So $2.66. So you collect $266. Now that assumes the market opens up where it closed on Friday and that the options haven't changed in valuation, which obviously when the markets open up things do change. But that's what giving it more time does. Now I'd have to take a look at Soundhound. Sometimes that's because earnings come out and the market can bounce around a whole lot. But you see how it really changes things when you go further out.
Yeah.
Which do you like better? Do you like doing it weekly, or do you like the idea of maybe going further out and less often but collecting more money?
I like the idea of a month, but a week also seems pretty good to me. Since
Okay.
I get to check up on it and see how it's doing.
Okay, so which
Instead of forgetting about the price.
I got you. So would you rather do the weekly?
I think I'd rather do the month this time, but do weeklies on others.
Okay, and which one sounded the most attractive to you?
Well, either the 16 or the 19, because the 19, of course, it's $266, but it's also kind of aggressive.
Super aggressive. Okay.
But the thing is, it did drop a whole dollar, correct?
On Friday.
So that is like a huge deal.
Mm-hmm. Well, so should we do the 16 and take the $1.28?
I mean, even if it's 19, you still have to buy 1,900 shares.
100 shares.
100 shares, so that would equal to $1,900.
Correct.
Which I don't mind buying in Soundhound since it's already been going so high up.
Okay, so we can do the 19 put. And do you want to do the 30 call for an additional 71
Yeah.
cents? So let's see, 260, 70, 80, 90, even 10, 20, 30. That's $330 in a month in options premium.
And even if I don't get the call, the put, I'll still have $300 to cover it.
Mm-hmm. And that's kind of how I think about it, is if I've collected a little over $300 from 19, if I'm forced to buy it, that makes me feel like I kind of really bought it at 16.
Yeah.
So even if it's trading 14, you see how we can go out a month later and get some premium to be able to sell a call that would be higher.
Mm-hmm.
Okay. So we're going to sell the 19 put for November 21st, and we're going to sell a 30 call
Can't believe it's
as
already
well.
the 21st though.
For next month.
I know.
Yeah. Okay, so which one do you want to look at next?
Wait, let me look at probably the open door.
Okay, so Open Door closed at $7.16. You had sold a $7.50 put,
Barely.
so you now have 200 shares instead of 100. And take a look at the options trade. Maybe we do just weekly in those, but
Oh wait, a put? Oh.
you got assigned 100 shares at $7.50 because you had sold the put.
Oh, I thought you said call, so
Yeah.
my time.
So now you actually have 200 shares instead of 100. So you could take a look. You could sell up to 2 calls if you wanted, and if you wanted to sell a put. Or I wouldn't sell more than 1 put. Similar the other way, like not wanting to be out of a trade on a stock that's going lower. I don't want to keep selling puts and selling puts and selling
You would
puts
wanna-
too aggressively and keep getting more and more shares, because maybe it's just a lousy company that we overpaid for, and you don't want to keep buying more and more and more all the way down. It's just very risky. Now, it's a inexpensive enough stock for the account that if you wanted to sell one more put, I think that's just fine, but I wouldn't get super aggressive on the puts.
I think maybe I'd want to sell an either 8.50 call or $8 call.
Okay, and what do they pay?
So the $8 call pays 16, and then the 8.50 call is 9.
Well, do you want to do one of each?
Sure, since I have 200 stocks.
Okay, and then is there a put you wanted to sell?
A 6.51,
And what does that pay?
15 cents.
Pays 15 cents. Okay, now I looked out of curiosity, but I still think we should stick with the weekly on that, so we have, kind of like you said, then we can review it again next week and go over all three, even though we have the monthlies on the others. And so Open Door, I took a look at the November 21st strike. For a $6 put, pays 57 cents. For a $5 put, it pays 25 cents. On the call side, an $8 call, which is pretty aggressive, it's only 80 cents away or something, but it pays 94 cents, almost a whole dollar if we go a month out. And a $9 call pays 69 cents, and even a $10 call gives 57 cents. So maybe, it wouldn't be such a bad idea. Maybe we do the 8 call and we do a 10 call for the month out.
Sure.
Does that sound good?
Yeah.
And then you collect 57 cents over a month, and then you
I
still
also
have
call,
the more aggressive one for the weekly.
which
And we
is
can
16 cents.
and we can adjust accordingly depending on what happens with Open Door this week. All right, so let's take a look at LAC, and you only have the option of going to the November 21st ones because they only do monthly, which is kind of why I looked at the monthly on the other ones too. So what do you like to do? Oh, on LAC, he was short a 750 put, so he got assigned 100 shares at $750 for the 100 shares. And now he's got a total of 200 shares instead of 100.
So this is a month away, right?
Correct. These are the November 21st options.
Wasn't this the one you were talking to me about before?
What about it?
The government?
The government has a 5% equity stake in them. So basically, and I'll say it so that you guys here know it as well, and what I liked about LAC. So LAC is a company that I think there's probably, and I'm just making the numbers up, an 80, maybe even a 90% chance that it goes to zero and becomes worthless. But I also think there's a chance it could go 10 times higher and go to $60, $70 a share. So they're a minerals company. They're Lithium America Corp, which is actually a Canadian company. But what happened is they had a big loan with the government. And as we've been getting into these arguments or discussions with China about the rare earth minerals, well, it turns out that this Lithium America Corp has some of these rare earth minerals. They were going to go bankrupt from what I could tell. They had a very big loan with the government. They couldn't make the payments. So instead of defaulting, what the government did is they've given them a time frame. I think it was 5 years, if I remember correctly, where they don't have to make any payments on the loan. In exchange for that, the government gets a 5% equity stake in LAC. Now, similar to Intel and similar how I feel about OKLO, which is a little bit different, I feel like by the government taking an equity stake, it's going to get some benefits and it's going to end up being a profitable company. But the fact that they had this loan that they couldn't make the payments on and it looked like they were probably going bankrupt is why I also think there's a good chance it could go out of business. Now, as always, this is not financial advice. Please do not listen to me or anybody else on YouTube when making financial decisions. You need to do your own research, reach out to a financial advisor, and decide for yourself what fits your portfolios. Sorry, that's a little disclaimer that I have to do. But yes, that was the one that I was talking to you about it. I don't know if that explains it more of what's going on with them. So I think it probably goes to zero and it's a big risk, but it really could take off and go crazy. So, anyway, what were you thinking about doing with those with the options?
Because you were talking to me about the government loan
Uh huh.
and about the OKLO or whatever.
Yeah.
Was that it?
Yeah.
I have a feeling it may go up, so I want to do a 12.50 call
Okay.
instead of like a $10 call. Because,
And maybe we do just one, and then you'll keep 100 shares even if it goes there.
yeah,
Okay. And then what does that pay?
30 cents.
Okay. So 30 cents. And did you want to sell another put in there?
Probably maybe 5.50.
And what does it pay?
40 cents.
Oh, that's a good payment. Now here's the one recommendation. If we get assigned another 100 shares of LAC, I would not buy anymore because it really could go bankrupt, and I'd hate to be advising somebody to keep buying a company that could go out of business. Does that sound okay?
Yeah.
Okay, so let's see. So for this week, that would collect if we get all of those 0.71, right? I'm just adding this all up. 266. 330, 340, 350, 365, and then we were gonna sell a further open door, right? What was it? 10 call for 57. 30, 40, 50, 410, 420, 430, 440. That would be $480 collected in premium between a couple things sold for a week out and some more things sold for a month out. That's pretty good return.
Yeah.
Now that doesn't necessarily mean like the account could drop in value if the stocks go lower and you're forced to buy more shares and everything else. But that's a lot of return on something that we put $10,000 in over essentially a 30-day time frame. So that sounds pretty cool to you?
Mm-hmm.
All right. Well, thanks for viewing. As always, if you could do me a favor and hit that subscribe button, smash the like button, maybe make some comments in the comment section. Let me know if you guys enjoy learning about the calls and puts and seeing that Jacob, who, forgive me, is a very bright kid, but I think he's understanding it and getting the hang of it, which was kind of the goal here. Any questions for you?
Not that I can think of.
No?
No.
All right. Well, have a good day, and I'll talk to you later this week. Bye-bye.
Bye-bye.